Hi you guys, welcome back to the channel. My name is Brad. This is the Firefighter's Financial Toolbox. I always like to try to show you guys any free tools that I find online because I feel like the more tools you have to help you in your investing journey, the more successful you can be. And today we're going to talk about a RMD calculator on Charles Schwab's webpage. As you guys know, RMDs are required minimum distributions. If you haven't heard about these things, I have a video out there and I'll put a link in the description, this one, for about RMDs. As you know, if you have any tax deferred assets, so if you have a normal traditional 401k, those are all, you got a little tax break when that money went in, but you're going to have to pay taxes on it when it comes out because of the new laws with the Secure Act. Now this year, if you're 70 and a half already, you guys, this year, because of the COVID thing, we have the CARES Act, and you can forgo this year's RMDs. But this is really a tool that plans for the future. Now, because of the Secure Act, and I have a video on the Secure Act too, I'll put that in the description. Because of the Secure Act, the RMD age actually changed up to 72 for people starting after 2020. So this calculator is still using the 70 and a half number, but it still gives you a good idea. So anyway, what I was saying is if you have any traditional 401ks, if you have a rollover that you roll over the 401k to an IRA, if you have a SEP or a simple IRA, these are all tax deferred assets. And the government gave you a break on it with the money when you put it in. They want their money back. And so you're going to have to pay. So with this, one of the things that's really cool with this, you guys, is it shows you a little bit about how much your money can grow and how big these RMDs can actually be. Now, we all got told early that, you know, you're probably going to be in a lower tax bracket when you retire and this and that. But I want to show you how much money this actually could be in retirement for you. So let's say that we start with a balance of, let's say this is for what we have right now. So let's say we have $250,000 in our account right now. And we're going to use my age, but not my real birthday here. And my spouse will be my beneficiary, and she is a couple years older than me. We're going to say we estimate we'll get a 6% return. So let's calculate what that's going to look like. All right, so we have to start taking RMDs at 72, right? So if we look at 72-year-old, we're only going to have to take about $31,000, you guys. Not quite $31,000. But what about at 75? That goes up to $36,600. At 80, that's gone up to $47,747. 85, we're at about just under $61,000. So that's not too bad. But let's say we're good savers, like I know all you guys are. And let's say right now we have $500,000. All right, so we put in $500,000. Let's see, we go to 72, you guys, and you see now we have to take almost $62,000 in the first year. We go up to 75, and that jumps up to about $73,000. We jump to 80. At 80, that's $95,000, you guys. And if 85, let's say we get to 85. At 85, we have to take $121,000. And you notice that our account balance is still growing. We're at $1.7 million. Now, remember, it starts at a little under 4% in your first year. And every year after that, it grows. So let's say that we have $1 million in traditional assets now. Now, I know that's unrealistic for some people, but let's just say. So first year, 72. Our first year, we would have to take $123,000, you guys. That's regardless if you don't need it. If you have enough money from Social Security and your Roths, you still have to take that money. And where this really can get you into trouble is when you or your spouse passes away, because you go from being in that married tax bracket to being single. And this can be a huge tax burden in your old age. Let's see, at 75, we're talking about $146,000. At 80, At 80, it's up to $191,000 that you would have to take out that year. And you see that the balance is still $3.5 million, which is a good problem to have if you're planning on leaving it to your heirs, you guys. But you can see that you may not need $191,000 in additional income to be taxed, but you have to take it. This is why we say maybe we don't want to have that. Maybe we have $1 million portfolio, but maybe we only have 500,000 of it in tax deferred. Think about where you save your money. Right now, because we're in a low tax bracket, might be a good time to think about putting money into a Roth 401k. And certainly think about always maxing out that Roth, you guys, because it's tax-free. And it's going to help you when you get older to avoid that tax bomb. Remember, the higher your taxes, the higher the percentage of Social Security is taxed, the higher your income, your cost for Medicare, all that goes up with more income. And you may very well not need that income, but if you have it in tax deferred, you're going to have to take it because the government wants their money. All right, you guys, I hope you got something out of this. It's a good free tool. I try to, when I find these tools, I try to share them with you. Let me know. Tell me how much you're saving. Are you saving more in tax deferred or more in tax free? Are you guys doing Roth 401ks or are you doing traditional 401ks? Now, if you're in a really high tax bracket, now I understand. If you're in 33 or higher percent tax bracket, you want that tax savings. I get it. But this is something to think about, that a lot of people were sold the bill of goods that we're going to be in a lower tax bracket when we retire. And I'm not sure that's going to be the case for everybody. Anyway, hope you got something out of this. If you did, you guys, drop me a like. If you're not already subscribed, you guys, hit the subscribe button. Ring the bell. You get notified every time I make a video. I try to make at least 1 or 2 a week. And I hope you got something out of this. We'll see you.